Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. One thing that is super cool about what we do as accountants is we get to specialize in all different types of areas. That may be niches in industries, that may be certain types of clients, that may be certain types of work that we do. And the most fun part about this job as your host of the show is I get to bring in people who specialize in all sorts of different things. And one of them is someone who specializes specifically in tax strategies for real estate investors. And that is a topic I know is quite popular because so many people are choosing to invest in that asset class right now. And to be honest, there are tons of tax benefits to that. There really are. So I'm really excited to welcome onto the show today, Chris Picciurro. Now, Chris is a tax planning and strategy expert for US-based real estate investors and a renowned presenter on the subject. He holds several accreditations, including CPA, MBA, PFS, and ARA. He also has past experience as an adjunct professor at Baker College and Davenport University. He's presented at various speaking engagements, and he's an active member of several professional organizations, and he's driven to innovate by his passion for helping taxpayers reduce their taxes paid over their lifetime. And he and I share that exact same philosophy on the concept of keep what you earn. It's absolutely essential for business owners and real estate investors alike. So without further ado, let's get to know Chris. Hey, Chris, welcome to the show.
Well, thank you for having me, and I'm confessing that I am a listener of the podcast, and I like all of your analogies, and I grab some tidbits, and some of them have really helped me out. I went out for an audition to be an NATP instructor, and I was assigned the subject 1099Ks, which is not my strength, and your podcast helped me through it. And it worked out, and they think I know enough to teach, so that's pretty cool.
That is pretty cool. I love it. I have to look into that too with NATP. They're actually a great resource. But today we're going to talk about something you know a lot about, which is real estate investing and the tax advantages to that, which I know our listeners are dying to hear more about. But first, before we get into that, Chris, tell me about you, your company, how you became an accountant, and like why you actually like this stuff.
Well, I love this stuff because I have the heart of a teacher and I enjoy helping people out. I'm more of an entrepreneur that decided owning a CPA firm was my easiest way to become an entrepreneur than a pure CPA that went into business for him or herself, which has probably been advantageous. Unfortunately, in our industry, we get confused that there are two separate skill sets. There's one man running a CPA or tax practice or an accounting practice versus being that technical practitioner. So, I've been very entrepreneurial from when I was a little guy. With my first job was a Detroit newspaper boy, and right outside of Detroit. And I don't know if anyone played that video game Paperboy where you chuck the papers and ride your bike around, but that was me. And it's kind of interesting when I think about it because one. First of all, I was banging on strangers' doors collecting money, which we only took cash, which is kind of weird when you think about a 12, 13, 14-year-old doing that now. But two, I had to do my own accounting. I had to buy the papers wholesale from the Detroit News. I had to mark them up to retail. I had to handle new clients / customers. I had to deal with cancellations and refunds. So that got me started with being an entrepreneur. And then once I realized I was not going to make it to be on the Detroit Tigers, I realized that a career path pivot was probably in order. Luckily, where I went to high school, we had an AP accounting course, and I took that. And I was always pretty good with algebra, and I feel like algebra students do really well with accounting, just with the double entry. And then got out of school, went and worked at a big company. They paid for my MBA, and started my own practice now 21 years ago. So, but that's currently It's funny because I was thinking about you, and I love the episode with your husband on it, talking about a reset. And what would you have done differently? Because I've been in business 21 years. And when I listened to that, I was just thinking, man, that's what I did. When I first started, we had 28 people on our team, 7 offices, 34 tax clients, and I was miserable. And I was, at least I started the business young enough where I did a complete reset. And now we are a CPA firm. We're 100% membership-based subscription model, specifically for real estate investors and some entrepreneurs. And that's our focus. We always hear niches equal riches, but I also feel like we're adding the most value for our clients in that space. So yeah, we have clients all over the United States. We had a pivot in life, reset in life about 7 years ago, where my wife and I moved from Detroit, and we wanted to find the best place to raise our family, and landed here in Franklin, Tennessee, which is just south of Nashville. And there's never a dull moment here. So it's pretty cool.
Absolutely love it. So, let's talk about real estate investing for our listeners who are either new real estate investors or aspiring. And I want to talk about what are the key tax advantages to investing in real estate because it's such a hot topic right now to build wealth. But beyond that, there are so many tax benefits as well.
Well, we in our practice, when we coach our clients, we've developed a proprietary system called Teaching Tax Flow. And one of the things we teach, one of our 3 laws, we come up with 3 laws, is that tax agencies are your involuntary business partner. So I know there was another episode. I just happen to listen to some of your episodes when I walk in the morning
Oh,
or walk
nice.
to play pickleball. I know we talked about that. We won't get on that tangent. And we talked about the difference between 1099 and W-2, and how with a 1099 person, the advantage is you get to pay tax on your net income, not your gross income. Well, the cool thing about real estate is that you get to pay tax on your net income. The vast, vast, vast majority of the time, that is not subject to self-employment tax, could still be eligible for a QBI deduction, and you get the depreciation deduction, which can be confusing. So another way I like to talk about depreciation is a cost recovery. So if you buy a property, like a residential property, you get to deduct the cost of that property over a 27.5 year period. And so you could see the advantages of, very rarely, our second law of teaching tax flow is understanding cash flow versus tax flow. So what other business can you have a positive cash flow and not have any taxable income, and potentially offset active income with your quote unquote tax losses, which we could talk about in a couple of minutes?
Totally. What are some specific ways? I know that there's, the real estate investors, right? There's real estate professionals. There's real estate. You could have like someone who just rents out a property, right? What are the different ways that you can
Mm-hmm.
engage in sort of business as a real estate investor in a tax advantage way?
Mm-hmm. Well, I feel like almost every business owner can use real estate in a tax advantaged way, even in its simplest form of having a home office deduction. And you don't even, as we know, you don't even have to own a property to take the home office deduction, but in that way. So the cool thing is just thinking about real estate from a bigger picture. You're taxed on your net income. By default, real estate is a passive activity, according to the IRS, and passive activity rules do play a role. Now, one of the things a lot of people out there, a lot of listeners, and a lot of people in the real estate community want to do is they want to take all of those real estate deductions in the year they've occurred, plus a depreciation deduction, and they want to take that first year. So the easiest way to be able to take advantage of all those deductions year one is to be what's called a rep status person. That's real estate professional. And to qualify as a real estate professional, it's pretty difficult. You have to have at least 750 hours in real estate related activities. There are, I think, 12 or 13 activities that qualify. Number 2, it has to make up more than 50% of your professional time. So someone like me, I almost have 750 hours into real estate related activities, but it doesn't make up more than 50% of my time. Now, here's the cool thing with rep status. If your spouse is a rep status, then you're a rep status. So one day I'm going to make a dating app for real estate investors, and it's going to say, I'm a high
Rep only.
W-2 person. I'm looking for that rep status girl, but I'm very happily married. I'm just saying, but that's another way. That's the easiest way for you to take these rental losses. Now, I know rental losses are a very confusing term, especially when you have positive cash flow.
Mhm.
Think about rental loss. Like, you can have it because you get a big deduction for the cost recovery or the depreciation deduction based on the assets you purchased that year, and that offsets your rental income. So anyone that's a rep status can automatically or typically take those rental losses to offset their active income. But I would argue that tax rates are going to be going up in the future, and that if you have a quote unquote loss from a rental activity on your tax return, even if you can't use it this year, it's not gone. It kind of works like that capital loss carry forward. It just carries forward as what's called a passive activity loss carry forward, and it could be utilized in the future. And if you believe that tax rates are going to be higher in the future than they are today, well, that's okay. That's not the worst thing in the world to have a deduction in the future that might be more valuable to you than today. So no matter what, investing in real estate can have a lot of tax advantages.
And why would someone want their income to be passive or to be considered passive by the IRS?
Well, it is passive by default, but one of the reasons you'd want it to be passive would be one, you're not subject to any type of self-employment tax. And it can offset passive, what we call PIGs, passive income generators. And it can carry forward so that, these passive losses, they don't just go away. So in general, people would rather not have their income be passive, but there are some advantages. One thing I should have mentioned also, one of these tax strategies that we like to teach is, and we always say legally and ethically reduce the tax you pay in your lifetime, but is income shifting to related entities. So for that entrepreneur that might be a self-employed dentist or let's say they have a small wood shop, if they lease the property back to themselves, and let's say the business is a Schedule C, and you form a separate entity, or you can always arrange it in a way to take advantage of those, to kind of skirt the passive activity loss rules legally and ethically if you group those activities together. But yeah, I think that the passive loss rules, a lot of times they appear to be a bummer, but I think with the tax rates going up in the future, it's not necessarily a bad thing.
Definitely. So, let's talk about the real estate investor who maybe purchases a property with the intention of renting it out. Let's talk about the rules around, like, maybe are there any differences between short-term and long-term
Mhm.
rental and how that can affect tax liability?
Absolutely. So there are, by default, we said all rental activity is passive.
Hmm.
For the long-term rentals, they would be most likely considered a passive activity unless you are someone that is a rep status. With short-term rentals are a little different. So a lot of the listeners, a lot of people out in the tax world and the real estate investing community are familiar with something called the short-term rental loophole. So sure, the IRS doesn't like the term loophole. So let's just call it short-term rental benefit. And there are special rules with short-term rentals that allow you to not treat that activity as a passive activity. In general, what happens is that, and I'm going to try to make this as low technical knowledge as possible, which isn't even really good English. So that's why I'm an accountant. No AP English for me, only AP accounting. But so what happens is let's say you buy a short-term rental property, and let's say it's in a resort area, and you are managing it on your own. So as long as the average stay in that property in a given year is 7 days or less, and you have what's called material participation, and there are several material participation tests out there. The most common one you want to think about is you are spending 500 hours within that property, managing it, putting it on Airbnb, VRBO, arranging the cleaners, et cetera, et cetera. I mean, communications with tenants. If you're having that material participation, so typically that's 500 hours or more, but also you have to have more than any other person, which is pretty easy to do unless you have some type of 10-bedroom place and you hire one cleaner every time, there's strategies around that too, to just rotate your cleaners. But if you meet the short-term rental loophole, then what happens is that quote unquote tax loss, think about the tax loss as just a paper loss. That tax loss, think about the tax loss as a coupon, right? You can only use a coupon at the store if they actually have the product that you're going to buy. But the tax loss then is deductible on their tax return on the year that you meet the short-term rental loophole requirements, and that can offset W-2 wages. Now, this is where it gets interesting. We call it blending different tax strategies. And that's where if you're going to qualify for that short-term rental loophole, a lot of times you want to blend that with the cost segregation strategy. And the cost segregation study means is that you are accelerating the cost recovery. You are accelerating the depreciation or the cost of that property into the first year to take advantage of those deductions.
And the cost segregation, just to kind of explain what that is, that's basically, is it my understanding correct that it's almost taking different components of the property and depreciating them at essentially different rates so that you can accelerate more of the depreciation sooner rather than later. It's just kind of taking more of what you would have taken, just accelerating it.
Yes. So, because this show is a great with analogies. Think about that you bought a box of cereal and you eat the cereal. When you look at the side of the box, which for someone like myself that ate a lot more cereal than I should have when I was younger and then realized what's in cereal, at least the ones I like, is pretty bad. But let's say you look on that side, the side of the box of cereal, and you see what is in there. That's a cost segregation study for your property. So by default, if you buy a single family home, let's say you buy a home in Pigeon Forge, here where I'm at in Tennessee, you're going to deduct that property over a 27 and a half year period by default. A cost segregation study has someone come in and they segregate out the cost of that property into 5, 7, 15 year. And now if it's a short-term rental, it'd be a 39 year because it's considered a commercial property asset class. Because of bonus depreciation with our Tax Cuts and Jobs Act 2017, because of the concept of bonus depreciation, that 5, 7, and 15 year property is immediately deductible. Now, if it's a 2022 property, obviously it's 100%, and that comes back down to 80% in 23. But even at 80%, it's very attractive. The takeaway I would have for someone listening, if you have a short-term rental property and you think you meet the short-term rental loophole and you're like, oh my gosh, why didn't I do this? I bought this property in 2020, COVID hit, and we scrapped all our vacations and just stayed at Airbnbs. And then we bought one. Well, let's say you bought this property in 2020 and you're just realizing now that you could have done that. Then I call it the get out of jail free strategy. That's why I have, for people watching, that's why I have Monopoly all over my office. You might say, what's the get out of jail free strategy? The get out of jail free strategy is you can go do a cost segregation study, still count it for your 2022 return, even if you bought the property in 2020. And you could pretend that you did it in 2020, and you could take a deduction for all of that depreciation you should have taken in 2020. Technically speaking, that's a 481A adjustment, but just think about it as the get out of jail free strategy. And when we look at tax returns, there's a lot of times where we identify opportunities to say, wow, we should have done a cost segregation study. Let's go back and do it. The other option too is, a lot of times, and this is something we talk about, tax-free income is a very powerful thing. And if, let's say you bought a single family home, let's say you didn't meet the short-term rental loophole, but you generate an $80,000 passive activity loss carry forward, and let's say that property nets you taxable income of 10 grand. I think it's pretty attractive to say, you know what? You bought this property, you do a cost segregation study. For the next 8 years, any money that you pull out of this property is tax-free from rent. That's really powerful. So
Yeah.
it's not always, I want the deduction now. And that's one of the things we've been teaching, that sometimes a cost segregation study is valuable, even if you carry the losses forward. The only thing, and not to beat a dead horse on cost segregation study, the only thing you need to be aware of, and I know you've had content on that, is that there are some depreciation recapture rules, and so this really works well with us with what we call a buy and hold, a long-term hold property. Because the cool thing is we know another advantage to real estate is if your parents, let's say, bought an apartment building and they've owned it for 35 years and completely wrote the entire acquisition price off, if they get hit by a beer truck, that's how I like to take people out, and you inherit that property, you get to reset the depreciation schedule up to fair market value. That's a huge advantage for real estate. Another
Yeah.
huge advantage for real
You
estate.
basically double depreciate.
Yes.
Especially if the value of the property has gone up, right? We've got step up basis. We've
Mm-hmm.
got resetting the depreciation clock. There's just so much there. And I truly believe, I've been saying this for years, and even to my mom and our families, we're like, put all your money in real estate. Like,
Mm-hmm.
put all your money in real estate and then give me that as an inheritance. Because that's going to be that's the key thing. That is one of, like, the secrets to really building wealth, I think, is investing in assets that are like physical property, like actual real estate.
And you can do a cost segregation study on inherited property. One other thing
Mhm.
I'd love the listeners to know, and again, hate hate to talk about this, but if you have a spouse that passed away, probably the
Mhm.
thing I see missed the most, and I don't know about you, is, I mean, obviously we're pretty much all real estate, is the step up in basis from a deceased spouse. At least
Yeah.
50%, and in some community property states, it could be 100% step up in basis. And that's just something that, unfortunately, a lot of accountants, because they let their workflow control them and they don't control it, they are scrambling around and they onboard a new client and they just take the depreciation schedules as gospel and slap them in their software and move on. So if you're a listener and you've lost a spouse, or if you've acquired a short-term rental in the last few years, sit down with your tax preparer, and maybe in the summertime or whatever, and really have a second look at it and see if there's any hidden deductions. I love deductions that don't cost you additional money.
Yeah.
They're there.
Yeah, deductions that don't result in you losing control of more money. So the step up basis we're talking about, guys, is basically a reset button when it comes to your really tracking the value of any asset. So that might be stocks in your portfolio, that might be a property. But if, for example, your parents buy something, or let's just use the spouse example, right? If your spouse bought something and it went up in value and then they pass away, and you were to, for example, hold on to that and maybe even sell it, right? You are only accountable to the increase in value from the point they died and you inherited it to whenever you sold it. You're not going to have to pay taxes on the increase in value while they held on to it. So basically, it resets the clock for you. Is that an accurate description?
Absolutely. That's a great description. And you just triggered something for me to let's talk about depreciation real quickly. Let's say you bought $100,000 worth of stock in, I don't know, Disney stock. I'll just make something up. Okay. That's just your basis. You don't get to deduct any of that $100,000 until you sell the stock. Well, if Disney was real estate, you'd get to deduct almost $4,000 a year as a deduction just for holding the stock. That's depreciation. So if you bought that property for $100,000, you're deducting almost $4,000 a month, a year, just for holding it, even though it might be going up in value and producing income. That's why real estate's so powerful.
Yeah. And that results in a lower tax bill in the process,
Mm-hmm.
which is like the best combination. So let's talk about, in line with that, let's talk about folks who maybe are real estate owners and are selling their properties. So if they're selling your property and you're making money on that sale, everyone is immediately going, oh crap. What does that mean for taxes?
Mm-hmm.
Because I bought a house for, they had this real estate boom recently where people were selling over asking. It was madness. And I'm sure people were thinking, wait a minute, I spent 200 grand on this house and now it's worth 700 and I'm selling it. Like, am I going to get smacked with taxes? How does this work? Talk to
Mm-hmm.
us about what happens when you sell a piece of property and how you can navigate taxes.
Awesome question. And you could tell that we put in hours and hours of show prep because you're hitting on the best points. Well, maybe we didn't, but that's all right. Back to understanding those three laws of teaching tax. So tax flow versus
Mhm.
cash flow. One of the misconceptions is that whatever cash you receive at closing of a real estate transaction is your taxable income. That is not the case. Many times your taxable income is much less than what you receive. And many times the tax burden is a lot less than you might think. You might say, well, why is that? Well, when you're going to sell a property, let's say it was a rental property, you have a few options. Option one is you sell it, you cash out, and you pay the tax. Typically, a long-term capital gain, I know we've talked, it's 15%, typically can be up to 20%. And then if you do take that depreciation deduction, there's a concept of depreciation recapture. So I always tell clients, count on about 20%. I'd rather set your expectation there on the federal level.
Mhm.
So you walk away 20%, you're paying tax on 20% of your gain, not necessarily what you receive at closing, but the difference between your what's called tax basis. And if you get insomnia, you can look at probably page 89 of your tax return and find it on your depreciation schedule. That's option one. So cashing out completely. When might that be a good option? Well, we teach diagnose, prescribe, diagnose, prescribe. When would that be a good option? Someone that unfortunately lost a couple $100,000 in the stock market and has a huge capital loss carry forward, and maybe they're never going to use that deduction. What that means, though, in layman's terms, is they have a deduction they're never going to take. So you might as well what we call harvest a capital gain. So it might make sense just to cash out and take the money and run. That's the. I'm not going to say there's no tax planning involved with that, but that's the tax plan. There's also, if the property's decreased in value and you have like passive activity loss carryforwards, I've seen situations where people walk away with cash and have no tax to pay. So that's option one, they'll just sell it. Option two would be something called a 1031 exchange. A lot of people have heard that term, and there's some complications with that. And I mean, my wife and I engaged in one last year, and it worked out really well on a vacation rental. With the 1031 exchange, think about it like this: you're not allowing any of that cash to hit your bank account. You are using a third party called a qualified intermediary to take the money in trust, and you deploy that money as your earnest money deposit or deposit onto the next property. One of the things to consider, though, on the 1031 exchange is that you have to buy what's called replacement property or your new property for at least the sale price of the previous property. So a lot of people think, oh, I netted $200,000 from that property, I have to buy something for $200,000. No, you have to find replacement property for the value of the one that you sold. Now, with the 1031 exchange, that's a strategy that you have to think about before you close on your property you sold. You can't let that money hit your piggy bank, or we have a little trouble. Another option would be, and these are not as sexy as they were a couple of years ago, would be to invest the capital gains in a qualified opportunity zone fund. And these are special types of funds. So kind of like, think about them like REITs or almost like a mutual fund that invests in assets in designated areas that have tax advantages. So this could be a whole nother show on qualified opportunity zone funds. The thing with the qualified opportunity zone fund or the QOZF is that you can do that for up to 180 days after closing or after you receive your K1. So Shannon, we've had clients come in and said, and it could be any capital gain actually, but I sold my office building. It was owned in an LLC. I got this K1. It says I've got this capital gain. What's this? I don't need this money. And the cool thing with QOZ is you can do a partial, whatever part of the capital gain you want to tax defer to 2026, you can. So those are the main options when you're, either defer, partially defer, or just recognize the taxable income. Now, if you're a rep status person, one of the strategies that a lot of people use is they say, okay, well, I'll just sell this property. I didn't do a 1031 exchange, but I have another property that we were talking about, those found deductions. I'll pair that cost segregation study with this sale. So those are some of the options. And we talk about real estate, when you think about tax planning and these transactions, think about it like this. Every December 31st, every year end is a closing for you. And you're going to the closing table. And you're either going to pick what you come to the closing table with as far as tax, or the IRS is going to pick. If you don't take any action or do any planning proactively, the IRS is going to pick for you. So it's important to, we talk about building your board of directors and before you close on a property, to think about those things. One more thing I would mention, transaction planning could play a role too. So let's say you're in a friendly situation. Let's say you own a commercial property and you have a long-term tenant there and they want to stay there. My son's travel baseball tournament was this last weekend, and I was talking to one of the dads, the grandpas, and I got this warehouse in Nashville. I've got a long-term tenant in there. I really don't want to own it anymore, but I'm worried about the tax situation. First of all, there's no 100% tax. You can give me, I'll pay a 30% tax if I get to keep 70% of it. But let's assume he doesn't need the money. Then what you could do is maybe do seller financing. Sell it to him and you become on a land contract. You can get creative within the rules, legally and ethically, to really do some tax planning.
Yeah, I absolutely love that. And I mean, the other part of it too, we were talking about selling a property. I wanted to bring into light the fact that if you live in the property, right?
Yeah.
That you know where I'm going with that. So you can go ahead and finish that.
Yeah. So no, great. So remember so we talk about tax agencies are your involuntary business partner. Well, because our friends in Washington, D.C., maybe we're saying that tongue in cheek, but because the House of Representatives term is 2 years, a Section 121 of the tax code was born. And what that says is that if you buy a property and it's your primary residence, coincidentally, 2 of the last 5 years, and you sell that property, you can exclude a significant amount of money from your taxable income. If you're a married joint, up to $500,000. If you're single, head of household, $250,000. Now, there are some limitations to that, but in general, that was, okay, these people that go to Washington for 2 years, let's give them a nugget. Let's give them that cookie so they can sell their house and do that tax-free. But the Section 121 exclusion is a great way to build wealth if you are
Yes.
open to moving around a little bit. And especially in the last especially in the last 2 years, we've seen a lot of downsizing and that sort of stuff. So you don't, a long time ago, you had to go buy another home and you don't have to do anything. You can go rent a place. You can go live in an RV and drive around. It's as long as you meet the Section 121 exclusion requirements. So that's a really, we call that in our teaching test. So one of our goal diagnoses is tax-free income and growth, Section 121 exclusion. And sometimes you pair that with residency planning, moving out of one of those really high tax states into one of these no tax states. And it can be very lucrative.
Yeah, absolutely. There's so many different dimensions to how you can use real estate to your advantage to save in taxes beyond the, well, I could just start a rental business or I could just, buy, hold and let it and, make money off of it. It's one of the few asset classes that is a primary wealth builder while also being a tax savings tool. And I love that there is that tax flow, cash flow type of interaction with real estate because you really can have a little bit of the best of both worlds.
Absolutely. And it ties into understanding, sometimes we have investors say, well, I'm a little worried about showing a loss on my tax return. And so, and we one of our lessons, bankability versus taxability. And when we talk about that cost recovery, that depreciation concept, remember that that's going to get added back to your income when you're looking at banking and as you grow your portfolio. But absolutely, I would say that, I only regret is I didn't get into investing in real estate earlier. And that's probably the biggest regret of most real estate investors. But that's, we're doing it now. And the nice thing is if you do buy a property, you've got the capital appreciation really, you still can earn income from it, even if it goes down a little in value or what have you. So one more thing I just thought of was we're talking about tax-free and strategies. Portfolio refinancing is another strategy that that's why when someone comes to us and they say, well, I really love this property. I own it free and clear. I need about $60,000 over the next 4 years for my child to go to college. So we're going to have to sell it. Well, wait a second. What if you just pulled equity out of it?
Right.
That's not a taxable event. Most likely we won't get too technical about basis, but most likely it's going to be deductible anyway. If you have the basis in the property, use that real estate as collateral to have some tax-free money coming to you so that you can still make those life choices. So just to your point, real estate just gives you a lot of flexibility. So there's a lot of cool things you can do with it. And I've really enjoyed it. And so do our clients for the most part.
This is amazing. So, Chris, how can folks learn more about what you guys have going on with your firm and get in touch with you?
Well, we have put together a special website. It's called teachingtaxflow.com/keep. So teachingtaxflow.com/keep. I know there's a lot of people out there that are just starting in their investment journey, and then there's some more experienced investors. We've put together a couple educational bundles. I think we took 40% off them. We're talking about $50 to really dive in and get a lot of great content. And just for the Keep What You Earn podcast listeners, this is just a special, no codes, just go in and check it out. And then I'm on LinkedIn, but the link to that is on that website. So.
Yep. And we'll be sure to include that in the show notes too. And Chris, are you active on any social media? Can people follow along and hear more from you?
Yes. So I'm on, we have a private Facebook group called Defeating Taxes, and we have Teaching Tax Flow Facebook group. And we have a Teaching Tax Flow podcast. If you are on pretty much all of the major outlets, and I'm on LinkedIn as well. And then we do have a Teaching Tax Flow Instagram and TikTok account. I will warn you that I do get my kids involved in some of the TikTok and Instagrams because they're fun, but we are really looking at, we do have a problem in our educational system with overall financial literacy and tax knowledge. So we're passionate about that, and we'd love to see. We're very interactive. We're very approachable, and we try not to use jargon, just like you, and try to break things down, because we know that, if I have someone that's a very successful plumbing contractor that buys and flips houses, the only thing I know how to do in plumbing is plunge something. And if that doesn't work, call somebody. So we understand, we stay in our lane, and we'd love to hear from you.
Perfect. Chris, thank you so much for being on the show today.
My pleasure, and have an awesome rest of the day. I appreciate you.
I can't believe how many episodes we've released of Keep What You Earn. There are literally hundreds of thousands, if not millions of dollars in tax savings contained in our episode library. And there are so many topics that we cover. To make it easier to find more of what you need right now, we actually created a custom curated playlist just for you. That's right, a playlist of value-packed episodes that you're looking for based on your goals right now in your business. Whether you're making your first sale, trying to strategize your taxes, or you're scaling your team, there is something here for everyone. Check out the podcast playlist generator now using the link in the show notes and explore your custom playlist. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.